You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Presented by NYFI.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is the esteemed Lars Jensen, the person of the year, might I add. Lars, how are you doing?
Doing excellent. I'm right now sitting in the sunny island of Montserrat, British territory down in the Caribbean.
Amazing.
I'm on my way over to visit the capital that got buried 30 years ago in a volcanic eruption.
Oh, wow. Interesting. For our listeners who aren't aware, Lars won an award last week. It was the Freight Forwarders Association.
New York, New Jersey Freight Forwarders Association.
That's awesome.
So they were kind enough to name me Person of the Year, which of course I'm extremely happy because it tells me that people are reading and listening to the stuff I do, which I find to be excellent.
Yeah, all the comments that I saw online was that it was very well deserved, which I agree with. So congratulations on that. It's awesome.
Thank you.
All right, let's get started with the juicy stuff in the material today. Let's talk about rates. Where are we at in the market?
Rates are going down, both the quoted rates from the SCFI, also the paid rates for the NYFI. Quoted rates peaked now about 3 weeks ago. NYFI has now also turned the corner, also turning downwards. All of this, of course, to a significant degree linked to the Chinese New Year effect. So that's not really exciting. But the real interesting part here is the early turnaround before Chinese New Year. Because usually rates do peak before Chinese New Year and then turn down, as we see. This year, it has happened several weeks earlier than usual. There are, of course, many different ways to slice it. What I noted is there's some analysis that came out here on Sunday from Sea Intelligence that shows especially the sharp drops on the Pacific. If we try to look at where is the spot rate peak usually, and how rapidly do rates seasonally decline from that peak. Within the first couple of weeks here, we have already seen rates on the Pacific drop more than what we should expect over 2 months after this peak. So we don't see that on the Pacific, apart from Asia, Europe happening a couple of weeks early. It more or less follows the path downwards we could have expected. But Pacific is outright collapsing much faster than what could seasonally be expected. We are already below where the bottom should be. So this shows the Pacific clearly being very weak. So rates dropping much faster than seasonality can explain. And it also did it much earlier. Not a good harbinger for the carriers.
Yeah, that's interesting that that's happening and a bit surprising. So we generally don't see that. Even in recent years post-COVID, that collapse, this is kind of unique to this year.
Yes, this is when you do seasonality analysis of what did we see over the last 10 to 15 years. This is unusually strong in terms of a downturn from the pre-CNYP.
So often we talk about a specific rate in the market where the market appears to be settled at. What's the one rate for this week? But I think it might be interesting to talk a bit about the spread and what we're seeing there. Could you talk about that?
Because we also do it here on the podcast here. We usually say this is what the rate is, then it's measured by one index or another. Mm-hmm. But reality is there are many shippers out there that have slightly varying needs, slightly varying contracts, slightly varying relations with the carriers. So the reality is, of course, there's always a spread. Nobody ships exactly at the index. It's always a bit up or a bit down, depending on circumstances. And the one thing I want to mention here is that's also an interesting part of understanding the market. Not just what's the volatility, but also what is this spread. And instead of being abstract, let me try to at least illustrate it with some numbers. Let me give a specific example. This week, if I look at China to US West Coast, NYFI rate, the reading this week is 1,932 to be exact, dollars per 40 foot. Again, keep in mind, this is cargo that's actually loaded. So this was booked 2-3 weeks ago. But that's the rate. But you also have the data available to say what's the spread. So if you look at the spread, the 25-75% spread, so that's where the ones that are between the 25% lowest, 75% highest, and in between, the spread is actually between 1,800 and 2,000. And we can also go to the 90-10 split. Then rates are between 70-70 and 2,080. So in this case, it's a $300 spread, which is a fairly substantial spread. So in understanding what happens in the rates, I think sometimes, at least in the debate over what happens with rates, people tend to get locked on. My rate is not exactly what the index is, but it should more be a matter of what is your typical offset? Are you still within the spread? Are you usually in the lower half? Are you in the higher half? And also to maybe put a bit of context, if you are, let's say, on the upper end of the spread, does that necessarily mean you're overpaying? That would also be a misinterpretation. It could also be a reflection. You might only be shipping 1, 2, 3 containers a year, whereas you might have some that are doing spot bookings, 1, 2, 3 containers per week. So that's also part of where the spread stems from. So when we talk about understanding spot rate developments, these nuances also become important at the individual shipper level. So it's necessary to go beyond the headline figure and then find out, compared to that headline figure, where am I at? And that's also why I find it interesting, precisely to dig into some of these spreads. Now, I was bombing numbers on people here. Feel free to go in and look up the numbers, but just to show how wide this spread sometimes can be, because I was mentioning the 25-75 split. So again, the ones between the 25% lowest, 75% highest, and then the 90-10. But even those two spreads are also sometimes out of alignment. If we go back just a year, in February 25, you suddenly had a difference in the spread of $1,000. And that basically meant that if you were in outer edges of this, if you were some of the shippers that were moving either at unusually low rates or unusually high rates, that could be up to $1,000 more dispersed compared to if you were clustered more or less in the center. In those cases, for some shippers, it might also have an indication, hang on a second, am I getting out of market? It can also, when I look back in time, signal periods of substantial uncertainty in the market. Because when you suddenly see that spread widen dramatically from one week to the next, it also shows that neither carriers nor shippers are fully on top of exactly what is happening in the market. So that gives us also more insight to understand, is it a stable market or is it a highly uncertain market that we're heading into?
Right.
That being said, the spread we're seeing right now is actually not unusually large. Sure, the spread is there, I mentioned it, but it is not unusually large right now, which also tells us that from the Pacific market perspective, yes, rates are beginning to go down. They're starting to go down quite rapidly, but the spread is not that high, which means that both carriers and shippers, at least to some degree, are in alignment that the market is apparently weak, and this is driving rates down.
Interesting things to think about when you're looking at the price ranges here. A wide spread is going to be a lot of transactions scattered at a lot of different price points, indicating that some shippers are getting very low rates, others are getting very high rates, and that shows the market is fragmented, a bit unsettled. And then when you move into a narrow spread, kind of like what we're talking about now, it's not an unusually wide spread, it's a bit more narrow. All the prices are clustered around that same price, around the average. And so, in other words, the negotiating power, the market conditions are fairly uniform, and you're not going to see a huge discrepancy. I think that's interesting to look at because we started off the podcast talking about what's the one rate for this week. And it's a bit of a misnomer to say that there's one rate that everyone's shipping at, but I think the spread is a really interesting dimension to add to it. So thanks for walking us through that. Let's talk a little bit about tariff news. So where are we at with the tariffs? Any new developments there?
What's happened in the last week is, I was about to say, real news and not just the social media statements. There were 2 executive orders coming out from the US. One of them is the removal of the 25% penalty tariffs on India. As you might recall, we had India being slapped with a 25% penalty for buying Russian oil. That has now been removed by executive order. That's going to be real. And the other one was an executive order that allows the implementation of tariffs on anyone dealing with Iran. Now, note that it only opens the legal opportunity to do so. What means to deal with Iran, how much you should deal with Iran, what levels this is going to be, we simply don't know yet. The executive order leaves the recommendations up to the U.S. Secretary of Commerce. So there's no new tariffs in place, but the legal framework for doing this basically from one day to the next is now in place.
Okay. So maybe let's focus on the one that's a bit more material here. So the removal of the 25% penalty on India, is that going to materially change anything, or is it more of a sentiment shift, in your opinion?
I'm seeing it will materially change anything. There was also an announcement that the reciprocal tariffs were going to be reduced from 25 to 18%. This stage in the trade war, we are more at a point where it's less what the level of the tariffs are. It is more the constant uncertainty. Is this going to change yet again? I mean, this removal of the penalty tariff is on the basis that the US believes India will now stop buying Russian oil. If that doesn't necessarily happen, or you might have private companies in India that buys Russian oil, this could come back at any one point in time, just as we saw the Americans backtrack on the trade deal with South Korea because it hadn't been ratified yet. So it's more the uncertainty, and the uncertainty, I don't really see that as having disappeared.
Yeah, that makes sense. Is there any new data on demand in general? Have we had any updates there?
Yeah, Container Trade Statistics came out with their data for cargo loaded in December. So that means we now have data for full year. In reality, there was not really any surprises. It followed the trend that we have been talking about every month for the last 6 months. We still have this bifurcation in the world. We still see the rest of the world, apart from North America, grow strongly, North America being down. If we look at full year, because now we do have full year data, global demand increased a little bit less than 5%, which is actually very strong. Whereas for North America alone, this was a decline of 1.3%, and the rest of the world outside North America was actually a growth of 7%. So even though this bifurcation only began from April when the trade war started, it had a material impact on the full year data as well. Even though that North American volume was actually positive in Q1. In North America was also up 3.4% in Q1, but was dragged down severely by the trade war. And we tend at times to focus on the big trades, Asia, Europe, Trans-Pacific, North America for sake of the trade war. But it's also interesting to know, if we look at full year 2025, where did we see some of the strongest growth in the world? And if we look from an export perspective, Middle East, India, and subcontinent exports grew 8.6% year on year. That was in December, which was a phenomenal strong growth. Imports to Latin America up almost 10%. Sub-Saharan Africa up 17.5%. This has been a trend throughout the year. So really strong growth, especially when we talk Africa.
Yeah, let's dig into that a little bit. 17.5% is a pretty an astounding rate of growth. What do you make of that? What do we expect? Do you think that'll continue moving forward? Is it a systemic change?
I see it as a systemic change. We've seen substantial growth all year, also before this. And when I look ahead, not just for 2026, but for the next 10, 15, 20 years, we should expect to see overall extremely strong growth rates into Africa. You've got economic growth, and you got a massive population explosion. Granted, this is from a very low base, so percentage numbers are going to look nice, but in measured in TEU, it is not that material yet, but it will get there. And if you're looking some 20 years into the future, you're going to be looking at some of the trades to Africa with the same magnitude as we're talking at, for example, the Atlantic trade today. So this is systemic.
Awesome. All right, well, let's talk about the Red Sea. What's happened in the last week there?
For now, Red Sea is positive news, which is nice to see. We had an announcement from Maersk and NYFI that there's 3 Gemini services that they're going to ship to the Red Sea. The one they're going to do already here from mid-February, so from next week. So that's the India to Mediterranean. That makes sense. India to Mediterranean, if anything, is severely affected by a massive detour. But then they're also announcing 2 Asia to Mediterranean services. It's the ones that Maersk calls the AE 12 and 15, and NYFI calls the SE1 and SE3. They will ship. They've just not disclosed the precise date yet, but what's to venture a guess? Again, this is going to happen in the wake of Chinese New Year, potentially from beginning of March, but that's my guess. It's not from the Gemini carriers. We also see CMA CGM. We spoke about it 2 weeks ago with CMA CGM, first shifting some of their Asia-Europe, actually the backhaul, Europe to Asia, switching them first to Red Sea, then around Africa, where I was explaining why this is more operational in relation to Chinese New Year, not risk-related. And I think that's backed up by a new look at, they have a come out with a message, but if you look at CMA CGM's sailing schedules, the Europe to Asia main backhaul service is now scheduled to permanently go through the Red Sea again from the end of March. So I think that sort of confirms the shifting a little bit back and forth on the FEL 1 and 3 was more operational than it had anything to do with the security situation.
Do you think that the slow reintroduction of vessels through the Red Sea is more of a strategic move in this case?
Yeah, I think if we continue down this path, I'm going to expect to see more carriers slowly beginning to do this. But doing this slow and gradual is the right way to do it in order to prevent catastrophic bottlenecks from arising. But when the ball starts rolling, I'm just necessarily sure that it's going to go as slow as the carriers would like it to. But time will tell. But at least for now, I would say these are all positive news from the beginning to the end of the Red Sea crisis.
Yeah, it definitely seems so. All right. Well, we've had some earnings reports come out from the carrier side of things. What are some of the main takeaways?
Yeah, a few weeks ago, we had O&E come out as the first of the global carriers with Q4 results. In that case, they had a negative earnings at the EBIT level. Maersk then became the second global carrier to present a negative EBIT also for Q4, which to some degree might be a harbinger of where the market is heading. Now, interestingly enough, it's just about an hour and a half before we were beginning to shoot this podcast. There were preliminary earnings coming out from Hapag-Lloyd. Now, no, there are no details. That's not how Hapag-Lloyd is doing it. A press release just with some very high-level numbers. And they are actually announcing an EBIT level to the tune of 1 billion euro plus. And that is clearly in contrast with what we saw from Boeing and Maersk. Now, as mentioned, Hapag is not presenting any of the details. We have to wait several weeks for those. But if we look at the high-level numbers they're given, I think we can also see how this has come about. Because we see a Hapag-Lloyd announcing a volume growth in Q4 of around 8%. This is stronger than global market growth, which is around 5%. And they have seen rate decline of 8%. A rate decline of 8% is actually very good performance. CTS data indicate a rate decline in the market of a bit more than 20%. If we look at Maersk, they also had strong volume growth like Hapag-Lloyd did, also about the same level, which tells me that the Gemini product that both carriers have launched are actually being successful in gaining some share in the market. But whereas Hapag-Lloyd saw a rate decline of 8%, Maersk saw a rate decline of more than 20%. And I think that might also be a key to them understanding how come Hapag-Lloyd was able to weather the downturn in Q4 and still have a substantial positive EBIT, where in this case, Boeing and Maersk didn't.
Yeah, they definitely seem to be doing something right. It'll be interesting to see what comes out of that report in a couple of weeks. I'm sure we'll talk about it on the podcast here. Interesting stuff. All right, so the last thing we'll talk about today is the Panama Canal. Are there any updates there that our listeners should be aware of?
I think we spoke about it last week. We have the Hutchison terminals that were stripped of their 2 concessions in Panama under the auspices of Port of Panama. That is, of course, good news if you look at it from the perspective that the Americans were angered about a Chinese presence in Panama. The result of this one has been that now the Chinese seem to be angry and threatening that Panama will pay for this. How this will transpire, we simply don't know. There was a report out by Bloomberg just before the weekend indicating that at least they had sources that the Chinese investment projects in Panama might be put to a stop. So we have yet to see how that one plays out. My own personal view on this one is I would not be surprised if we then suddenly begin to see a revival of the Nicaragua Canal project that we saw 10 years ago. For those that don't remember it, there was seemingly a Chinese project to build a Nicaragua Canal, which would be competing with the Panama Canal. It never materialized. It was, at least the way I see it, always unclear exactly who was behind it. When I was looking at the project, again, keep in mind it's about a decade ago, I had a hard time seeing how that project could ever be commercially viable for the investors, even if you look at it in a 100-year perspective, because it would just be a straight up competition on price with the Panama Canal. Of course, had such a Nicaragua Canal been built, that would also be extremely detrimental to the Panamanian economy. All talks about that Nicaragua Canal then seemed to vanish into thin air the moment the Panamanian government stopped to have diplomatic relations with Taiwan. My interpretation of the event seems that this was simply geopolitical. This was China telling Panama, either you stop recognizing Taiwan or we will build a Nicaragua canal and severely damage your economy. If that is indeed what transpired, the way I interpret it here, I would not be surprised if we then, over the coming months or years, might see a revival of the thought of the Nicaragua canal.
Okay. Good context for our listeners to have. It's definitely something I wasn't aware of, so it's good to know about that. Well, we'll keep an eye on that and obviously share updates as things progress. But I think that is everything for today's episode. I hope everyone listening has an awesome week. If you haven't already subscribed, we are on Spotify, Apple Music, YouTube. Make sure you subscribe so you never miss an episode. And we'll be back next week. Have a good one, everyone.
Thanks for listening to Supply Chain Secrets Podcast, presented by NYFI. Be sure to subscribe on your favorite podcast app. Want to be a part of the show? Register to attend a live recording at the link below.